All right, this is Ken at Tortoise Capital, and this is the Sunday Night Strategy podcast for April 19th, 2020. So I'm going to answer questions about the this weekend's report and prep for the week ahead after I go through this series of slides. And so what we're about to see is a set of 18 sketches and one-pagers and quick slides that we've used in the 2018 and 2019 live trading focused workshop to really lock in the important questions that the traders had in each of those live trading workshops. So the setup on that is that these were all guys that had come to the live trading workshop, had gone through the standard courseware and listened to the videos and worked on it at a distance. Got some review lessons, and then we went about learning by doing. So creating small trading teams, practiced our elevator speeches, our trading plans for the next day, then went through the live trade together in our groups and then as part of a larger group. And inevitably, there are a series of teaching cases and learning moments, teachable moments that happen, some questions and answers that come about only when you are putting this stuff into practice and you're at the implementation phase, and now some things that are not at the craft knowledge of confidence yet emerge. And so these 18 handouts, these slides, all represent responses to those common important master classes in the moment that were very well received by the guys in the workshops, and these were things that we kind of reinforced. And so I thought I would leave them in the form that we used them and we built them, because there's a certain power that comes from the authentic original carving, if you will. All right, so these are not linked in any particular way, or not sequenced, but this was just the way that we went through them. So the first one is a sample of swing strategy. So if you're a swing trader, sometimes you just need to find things that are going to get started well, and then you grow into the trade. And sometimes you want to use swing trade candidates to leverage your intraday trading. So you want to find things that are postured to move larger than average moves in either direction in shorter periods of time than normal. So that's what we mean by a swing trade. There's some kind of short-term price anomaly that's going to drive it to move fast and far, and may catch some people by surprise, but which we can detect on the basis of prior conditions. So this idea of strategies fits into my model of strategies, systems, techniques, and tips. So strategies are our generalized top-down approaches to opportunity, and we have certain principles and standard practices, but they're not codified in a mechanical way, but they are a way to get started, a certain stance to have with respect to the market. We're looking for certain kinds of moves out of certain kinds of conditions. So it's a relaxed way to approach all forms of trading, not just swing trading. But this is centered on swing trading because that is at that midpoint between long-term trading and day trading. So for me, it has the most applicability to most traders who may not be full-time traders, but who are looking to find ways to exploit these repeating patterns in a relaxed way. So a system, on the other hand, is something that we have codified to the point where we can actually code it and have it robotically traded. It could be traded mechanically. Either you're mechanically following the rules precisely, or you could code it into a trading robot to trade. So it has that extra degree of precision. It engineers out the discretion. And then a technique. So if a strategy is a broad and relaxed top-down approach, and a system is a meticulous, precise, mechanically tradable set of code or pseudocode, then a technique is like a self-contained module or a process or checklist or an SOP or a procedure that is repeated, that is a common tool, a standard practice, and can be applied as a building block to construct a strategy or a system. So something like the 2R battle drill, or the 1-2-3 entry, or the Z3 pinch, those are all blocks of code or concepts that have a wide applicability to day trading, swing trading, long-term trading, and which could be a component of a more complete system or of a broad strategy. A tip is just a factoid that is persistent, that we pay attention to, that just stands alone as an important thing to know. Like, for example, on swing trading and long-term position trading, on weekly charts, if you see the RSI 14, standard construction, RSI 14 goes below 30 on a weekly chart, that's so rare that that is an alert that you are in the presence of a significant sell-off. And then when that RSI comes back above 30, that is a tip that whatever price sell-off just happened now has reversed enough that you could get long and treat that sell-off as an important swing low. So that's just an example of a tip. A tip could grow into something you turn into a technique. Like, you could start adding more things to it to make it a technique. That could be applied to a system. It could be, built out into code that is a complete standalone robotic trading system. It could also be built out into a strategy. Like, you could just have a strategy that says, let me look at 1,000 symbols and scan them for a sell-off and recovery in RSI 14 on weekly charts, and then go frame that trade in the usual way using RLCO techniques. That's a strategy, okay? But the tip is that the RSI 14 level of 30 on a weekly basis, when that gets breached, it's an important tradable moment developing because it happens so rarely. Now, interestingly, the same condition does not apply on the other end, like RSI 70. A breaching that does not signal a major turning point, simply because the market spends a lot more time in a kind of grinding bull markets and upward price action than sharp sell-off. So it's not symmetrical in that sense. So that's the limitation of that tip, or that's a second tip. So I say all that just to say you need to appreciate the difference in my mind between strategy, system, technique, and tip. That's more of that in the boot camp course. And that's the context you need to know as you see me now getting ready to talk about a sample of swing strategies. Now, what we used this little checklist for was as a note sheet when we were going through the daily reports, because we were practicing how to pick up strategies on symbols that looked interesting just on the basis of these very relaxed strategic ideas. And so I'm going to work through those, and you can, if this appeals to you, you can then take a look at this and then look at the weekend report and then pull out symbols, and you could plug those into these little spaces. And that's the way we used it, was as a note-taking sheet, a little template. I've turned an Excel spreadsheet into a little systematic note taker that's like this, but there's a certain power in the way this thing is organized to just look at swing strategies. So the first set of 4 deals with MACD 4 seasons, and as we know, spring, summer, fall, winter. Look at the daily report for those definitions. But in general, what we're looking for in spring candidates that are in the spring have experienced a sell-off but are now recovering, and so we think we're having a chance to buy something on value as a second mouse before it's gotten back to the fair value. So we're front-running the confident third and fourth mouse who waits for this thing to get into the summer. In the summer, we know that we should have a long side bias, particularly if the market is in the summer and our target is in the summer. Then this is part of the reason the market's doing well, is because it has candidates like this. And so when you find things that are in their summer, you have a long bias on them. and you look for the ones that are the relative strength leaders, and you want to just get more of that. You're rewarding momentum and trying to hitch your wagon to that train. Now, in the fall, what we've seen is that that had been a good long side move already, but is now starting to weaken, and it may even be falling, but not so much as to trigger a winter condition. But this is one of those where you're thinking about preserving your gains, but also watching to see if it's going to get a second wind. And so we know the pattern of summer, fall, summer is an instant long. That's the case where you're going to have a second growing season, and you want to exploit that. And then finally, in the winter, we want to have a short bias, and you're looking for the weakest of the weak and looking for opportunities to exploit intraday weakness if you're me, or you may be willing to take some short-term short side swings for candidates that are in the winter. So as we go through the various report pages that deal with MACD histogram, those are the kinds of strategies that we want to use on the basis of the season that it's in. When you add an extra layer in there of the market and the sector and the target, you can then start getting some combinations in there. Like you might really like the market in the spring and a symbol in the summer. That would be an indication of something that already you could have a long side bias on, and whose very strength is part of the reason why the market was able to turn from winter to spring. So you're really buying relative strength leaders in their summer while the market itself is in the spring. All right, second batch, pinch and stretch. So on the pinch and stretch report in the daily report, what we're looking for in those four columns are these things. So the Z stretch plus finds those that are the most standard deviations stretched above their Bollinger Band mean on a Z-score basis. So we look at those 60 symbols in the ETF stack and the Dow 30 stack, and we compute the Z-score of where they are with respect to their Bollinger Band mean. So where are they in the river and the floodplain and all that? And then we assign that Z-score to show its relative strength against its own river. So the one with the highest Z-score stretch is the one that has the greatest breakaway to the upside above its own Bollinger Band mean. And so that shows a relative volatility and relative strength that makes it stand out. So that would be one where you would look to frame that for continued momentum, or if you were already in it, as one that you wanted to preserve that really exceptional move. So the same thing happens on the Z minus stretch. These are the ones that, especially in a weak market, are the ones that are leading the way down. And you wouldn't be surprised if they continued to be weak as time went forward. So you might frame those as candidates for collapsing dragons or reinforcing negative momentum. The third column represents wide rivers. So the way you get a wide river is to have a significant directional move over the past 30 bars. And so the more directional it is, the more that that range is piling up in one direction rather than the other, and that's going to make the river just get wider. It'll have directional volatility. And so on that chart, it's sorted again by the Z-score of the width of their river. So if something is the highest Z-score on width of the river, then that's something that has had the most remarkable directional movement compared to its history, compared to the other members of that 60 symbol stack. So these are the ones that have experienced them. You wouldn't be surprised if the ADX was also high as a measure of strength of trend, but this is just another proprietary or unique way of looking at strength of trend that other people may not see because of the way we use that indicator. And similarly, river narrow would be ones that are exceptionally sideways in a quiet channel, and you only get that when there's a combination of small daily volatility and lack of directional moves. So you get exceptionally compressed rivers and floodplains in those conditions, and that's going to lead you to things that look like Z3 pinches, which is what you would get, a super pinch or a Z3 pinch, if that box containing the Z3s are less than a frog box, for example, intraday. Or a super pinch if the 4 regression lines also happen to be contained inside of that box. The doggies see a squirrel outside. All right, so moving on. When we look at the Dow Tactical 30 and the ETF Tactical, what we're looking for in those are strategies that can alert us to different kinds of conditions. So the RSI2 column I like to look at right away, and what that is looking for is something that has a single-digit RSI2 value. So if it had like a score of less than 10, it's going to be highlighted in the green. And what that means is that you're looking at something that over the last 2 days has had such an exceptional sell-off and closed so poorly that it drove the 2-period RSI to single digits. And that could be the front end of a short-term washout pattern or a moment of tactical reversal. So the next day, it wouldn't surprise me, for example, if it had a big gap down and then a sharp morning hook reversal. And you can often frame some trades that have some hybrid frog characteristics on an RSI2 of a single digit, especially if the rest of the market is doing fairly well. The more it's an exception, the more interesting that individual target becomes, and becomes a candidate possibly for a hybrid frog. Now, that's a tip, and that's also a technique. It could actually become part of a system or a strategy if you then combined it with some of the other indicators that would give you additional reasons to be interested in it. So, for example, if you had that low RSI2 and it was near a 10-day low or had just breached a 10-day low as well, then that becomes even more of an interesting element. So the RSI2 is at least a tip. It's also a technique and can be part of a nutritious, delicious strategy and system. The auto framer is a strategy all by itself, and that is a reward to risk ratio for swing trading that is based strictly on trade location and the size of today's range. So if we are a far distance away from the 10-day moving or the 10-day high, which is our proxy for a reasonable target for long side swing trades, and today was also a small range day, we then express the distance from today's high to the 10-day high as a multiple of today's range. So if we used today's range tomorrow as a trailing stop, what we'd look for is, well, what would happen if it opened inside yesterday's range and then proceeded in an orderly way to take out today's high on its way back to the 10-day high? If we just automatically bought that on the universal entry, 5 cents above the high, and we just used the range risk as a trailing stop, what would be that reward to risk ratio? Well, that's the ratio that's reported on the daily report. And so the auto framer is a way to rapidly, visually, based on trade location alone, find things that are otherwise very interesting to trade. We found the auto framer as a strategy and as a technique when we were going through mechanical swing trading, and we found a lot of symbols firing at the same time in different systems, and we needed a way to rapidly evaluate the reward to risk ratio. And then after 3 or 4 years of using the auto framer like that to further qualify mechanical symbols, I finally woke up to the insight that, oh, we could actually find things that are easy to trade or worth trading simply on the basis of the auto framer itself. It didn't even have to have a signal generator otherwise to alert us. So that's where the auto framer came from, and it has become a standalone strategy for me. The next two deal with the regression line fractal framework, and I talk about that every day on the daily report, where I talk about the top shelf and the bottom shelf. And bottom line is that strong RLFF means that this is something that has, where the RL10, the price, has moved a number of ATRs past the RL270, which is the fair value for long-term holders, and that creates an overshoot of price versus value, that the value hasn't caught up to it yet, the long-term guys. So this is something that the short-term traders are seeing, and it's been rewarded with momentum. And so that lets you look at things that might continue to attract more momentum while the long-term guys try to add to their positions. Maybe that's who's buying it. Or it may be something that once it stalls, you want to preserve that profit if you're already in it and prevent it from going all the way back to the fair value. So RLFF strong has a couple different strategies or ideas that are connected to it. Similarly, RLFF weak is going to lead you to find things that have already experienced a significant short-term sell-off, where the RL10 is a number of ATRs below its long-term fair value, and you're going to see one of two things happen there. That's either going to be a candidate for continued shorting, or it may be that once it starts to reverse, you can frame it like a second mouse and give back 1/3 of the recovery and hope to get the 2/3 of the move once it started to move back to fair value. And maybe you would settle for the middle third, aim for 2 and take 1. So if something was 6 ATR away from its RL 270, you might let it get 2 ATR off the swing low and then just buy it with a 2 ATR trailing stop, reasoning that you had 4 ATR potential to the upside. And then while it starts moving out, maybe it gets to plus 2 ATR, so you have an R in hand and it starts to stall. Then you can decide whether or not you want to maintain that position or recycle that money to the next best idea. So RLFF strong and weak gives us a way to rapidly classify things on the basis of trading momentum versus fair value. Max Pain range compression is closely related to the auto framer, but this one also simply takes a look at returns to the 10-day high and the degree to which the range has compressed, and it does some computations to find out which ones have the maximum losses divided by the smallest gains of the day, or the smallest range of the day, and that is expressed as a ratio. So it's very similar to the auto framer in that sense. The auto framer has a little bit more nuance to it in how it selects the actual risk to be used, but the MPRC is the brute force formula. And then finally, the squeeze is something where we're looking for symbols that have had a relatively large average range over the last 30 days, and then have had a one-day range compression so small that if we just bought a mechanical entry breakout and used the range risk as the trail, that and if it just moved one range stat from the high, that it would give us a payoff better than 2-to-1. So this is another way to trade swing trading one day at a time, which is a meta strategy where you might use any or all of these elements, simply trying to find symbols that could move out large in one day, start them with hybrid frogs, and then maybe decide to grow them into swing trades if that's what the market sector conditions would support. Or it becomes a meta system for finding enough symbols to prepare for intraday hybrid trading, and then just looking for swing trading one day at a time, and then waiting to see favorable market conditions to start holding swing trades. So that's page 1. That's such a large idea. That's why it's number 1 on our hit parade, because it really represents a way to straddle swing trading time frame, where positions take days and weeks and months to unfold, and pure intraday measured in minutes. This is a way to straddle that and a way to implement core and turbo. So when I'm looking at symbols to prepare, I think of 3 groups. That I think of my intraday targets, where I always have hybrid frog and frog champions and things that I prepared from the day before that traded well. So I start off with things that are always my intraday targets, the usual suspects. And then I might add to that list of things to prepare any swing targets. So anything that fires on a mechanical system or comes out of my strategic review that, like I just covered on slide 1. And then I'm going to perform some day 1 intraday techniques so I can get started well on the next day. Plus, I'm always going to prepare my frog champions. So these frog champion symbols are the symbols that not only trend very well intraday, which make them great frog candidates, but also tend to trade very smoothly as swing trade items. So these are ideal candidates for doing intraday, core, and turbo, and then growing them into swing trades. And when they come to major turning points as swing trades, then they become even more favorable as intraday frog candidates, because you'll notice that the intraday volatility will increase at significant swing turning points as a lot of people's minds are changed and beliefs are changed. So you get a lot of volume and you get increased volatility at those kinds of turning points. So those are the frog champions. So these are the three buckets, if you will, of symbols that I'm always going to prepare every day after reviewing my daily trading plan. We then construct a logic chain out of that, and we go through this exercise in the swing trading course, and this just happened to, or the day trading course as well. And so we happen to use this one where we started off, this is like a radial technique. In the middle, we start off with the S&P, and then in the vertical stack, I'm always going to compare the S&P to the Dow 30 and the Russell small cap in the US. Going down, I'm always going to compare it to Brazil and Mexico. If I just want to do index trading, I might just use those five. And then closely related to the S&P are VXX and its derivatives and TLT treasuries, the volatility and the treasury. So I can just use those inside three as a way to get a rapid estimate of what's going on in the market. And those are tradable all on their own as well. Or I might go out to those other indexes north and south of the S&P, and then I can look at their relative performance to see what kind of a day is unfolding and where is the money flowing during the day. Well, the next layer outside of those, I'm looking at four specific XL series symbols. These are sector spiders that are the four least correlated and often are the most volatile and can quite often lead or lag the market in significant ways. Like the market could be going up and XLK might be going down. Or similarly, energy might be going down while the market is going up. So I look at XLK tech, XLE energy, XLF financials, XLB basic materials. And it has some basic industries in it as well. Now, lately, you've noticed that I have added XLV healthcare, and that's because we're in the time of the virus. But the same idea applies that if I get the market right, I've got about 50% of the formula solved. And then the sector is another 25%. And then finally, the outer ring represents individual targets of interest inside each of those sectors. So when I'm looking at energy, I might look at UNG Natural Gas, Chevron, Schlumberger, Devon Energy. XOP is oil exploration. XOM is ExxonMobil. USO is oil itself. Technology, I'm always interested in Intel, Facebook, Microsoft, etc. So this gives me three rings on this radar screen of being able to rapidly find where the market is moving, and we call this the logic chain. And we have constructed scenarios that allow us to imagine how the market might unfold: market up, market down, sector up, sector down, and all the combinations thereof. And then if the market is up and the sector is better, if one of those symbols is even better than the sector, then that's what's pulling everything along. And then I want to be on the find the mover. And so that's basically how we construct our logic chain. And then each day in the trading, in the live trade workshop, when we have guys are putting together their plan for tomorrow, we not only find the symbol sectors of interest, but we also build scenarios and individual logic chains so that we can find the movers. And then we rehearse how we're going to do that. And then we set up our indicators to make sure that we get visibility on those key tells. So that's the sector. This one is my thoughts on the all-important top-level process of plan, prepare, execute, and assess. And I'm not going to read it to you, but I'm going to suggest that you read it and understand why I have capitalized prepare and then capitalized assess, because of the importance that I place on those. And so that's a very important strategic mindset and psychological mindset to adopt, that I really want you to understand that. Here's another psychological lesson that summarizes an article from Farnham Street, which is a summary of the mental models of Charlie Munger and Warren Buffett. And it really just describes the 18 differences between amateurs and professionals. And I use this as a rubric to check my own emotional and professional state of mind, and try to assess myself, particularly if I'm not in the zero straight state or I'm not satisfied with what's going on, or at least once a week, just scan that and say, where am I on that rubric? Now, this is one that I want you to study. I'm not going to cover it in detail because each one of these three sections is its own daily lesson, and I'm going to maybe get to that like this week. But three elements of trade management. One of them is, well, how do you know which of the entries to take in these systems or strategies? And then how do you know which of the exits to take in these systems and strategies and tech? Each one of these is an exit and entry technique, and I've listed them in the order of appearance. And you'll notice that that this is based on a long side trade, and that the ideas in their sequence are in many cases symmetrical, like they occur in the same order on either end of the curve. And so these are the areas where if you notice how price behaves at the beginning and the end of moves, then you can really decide which ones you want to use and what do you want to specialize, and decide which one was your particular reason to make your exit, and then live with that, and then study with the results you get when you use these different techniques. And these are all about elements of trade management. And if there's something on there that you don't recognize the word, then you know that you have some work to do in the glossary. And then finally, the thoughts on trade management is going to be its own separate briefing. And these are all psychological principles to keep in mind as you're managing trades. Each of these on the next chart are little flashcards that illustrate some of those very key components that were just in words on the previous chart and should be studied to see what they represent. If you couldn't put a 3-minute speech on any of these charts, then you know you have some work to do, and you should follow up with a question to me, or wait for me this week to get the language built in. But you should try to figure out what I'm going to say, so that when I say it, you can compare your understanding of that flashcard to what I actually said, and that becomes a good check on learning, in the same way that Glenn Osborne described how he was going to compare his ideas on the chart markups to what he actually did, and then compare it to my work. This one articulates the difference between the execution risk and the position sizing risk. There's a very good narrative of this in the boot camp video that talks about that difference. And so you should be able to give that speech yourself and be able to articulate why the execution stop, in my view, must be separated from your position sizing stop, so that you don't create harm in your portfolio equity curve oscillation, which can throw you off your center. And it talks everything to do about understanding the hypothesis of why that trade should work, and then what price triggers the entry as an indicator that the move has started to work, and then therefore what price would indicate the end of that hypothesis. What is the price that you need to see that indicates the null hypothesis, or the failure of the science project, or the hypothesis is rejected? And then that's the execution risk. And how does that relate to the size of your standard position sizing risk, so that you can approach the capture of R and the analysis of R in the same psychological state, trade to trade, regardless of the system that you choose? So that's important. This one is for This is a one-page summary of all of the mechanical swing systems that are in the home study course, the one that's at VTI and that I used to teach exclusively. And so there's anywhere from a 5 to 7 page summary in words of these concepts. But if you rendered it down to a single page, a single column of the important elements, you could code a system on the basis of the information on there. So this is a rapid one-page visual summary of the 7 standard mechanical swing trades. In fact, this was the chart I put together so Bill Brower could code the systems into the TradeStation bundle, and the chart that Danny used in order to code the systems into the TC2000 bundle. And in my view, it's everything you have to have specified to have a complete system ready to code. Well, if you were looking to turn a strategy or a bunch of techniques and tips into a system, then you should be able to fill out a chart just like this for each of your proposed systems. And then that would let you know if you really understand your system, if you could put it into that kind of pseudocode and have somebody else understand it. This is the standard questions of the trading process that I use to develop the architecture and visualizations and rehearsals of every trade that I take. And before you enter a trade, you should have this complete trade process sorted out. And so it starts with, on a trade frame, what is it that you see? And can you describe in words exactly what the indicators are doing? Not you making sense of what it might do yet, but can you just describe what you see objectively? Then, what could it do in either direction? And when I say what could it do, I mean reasonably and unreasonably. What would be the maximum reasonable intraday move from that location if it was an intraday trade? Or if it was a swing trade, what would the RLFF suggest that it could do to the limit of normal? And if it went beyond, what would be the maximum of normal? Then which way do I want to trade? And then which way would I trade, which could be different. Like it could go in either direction. That doesn't mean I'm willing to trade it in both directions. Would I? And if I would, where would I enter? Where would it fail? That's the hypothesis. And then if it went one way and then it failed, would I stop and reverse, and how? Then if it was a winning trade, let's suppose that the thing went in the direction you wanted to trade and you got your entry and you were able to get to a no lose plus dinner for 2. Then you go on to rehearse this. Where would it stall? And that should at least be the 2-hour battle drill point of view, because that's what you had to have in hand before you entered to ensure that the reward to risk was appropriate. Then at what point on the movement to 2R would it become more important to preserve my gains than to hold out for more gains? From the moment where I make a decision to do that, and then if it gets to my expected 2R move, where could it go from there? Is there another 2R of the same dimension above, or where's the next support and resistance? And that's how you construct the upside price ladder as far as you can see. Then if it got that far and then it hit my 2R battle drill exit, would I stop and reverse? If so, why? And then if it got me out, whether I stop and reverse or not, if it then resumed in the primary direction of the trend that I just got out of, where would I re-enter? So if you answer these questions for every trade that you propose to take, you will have rehearsed all the important decisions that you can possibly make once you've entered the trade. And then you can rehearse those decisions, and then you've seen that trade before, and you're not surprised by what it does, only maybe by the speed with which it does it. But because these are all geared towards price levels, it doesn't really matter how long it takes to get there. You've already anticipated what your decision points are going to be at each of those critical states. So get in the habit of using that trade process to frame your trades. This is just a summary of how to set up your own charts using the regression line and Bollinger Band and MACD histogram framework, and how the colors we use and the parameters and the interpretations. This is a flashcard that talks about how to play the oscillating wave And this is one that I think you should study. And this is especially treating what do you do when you get into a Z3 pinch and it starts to break out and then maybe stops and reverses and goes the other way. And how can you use the Z-score ladder from Z minus 3 to Z0 to Z plus 3? How can you use that for decision points based on how this thing is moving? And what I've done is also arrayed different measures that we use intraday to compute reasonable moves, and then the language that we use to describe the behavior that we're seeing. And this is all part of that what do you see? And now we're providing a language with standard descriptions that allow us to be very precise about what we see and what we mean. Here's a flashcard on the owl and the criteria for how to trade the owl on a one-pager. It starts off with an unambiguous move, which means that the price, the RL10 and the RL30 have all left the river. When the 30 leaves the river like it did at the start of this box, that's the beginning of trending behavior. At the red dot, you notice there's a collapsing dragon, and if that's where a guy got short, and then it made this long, powerful move to the bottom and then got a P1, you would see that as an unambiguous move. In this case, on a intraday. After an unambiguous move, criteria 2 is a P1, which is a regression line crossover outside the river. You see that here. Then the RL10 crosses the river. That's criteria 3, the RLXD. I've been teaching you that that's actually a trade you can take. It's not an owl, but it's an RLXD entry, and sometimes you're willing to take that risk. That's your choice. And then criteria 4, the dragon is turning up. It is right here. And then criteria 5, the RL30 also rolling up. Those are the 5 criteria. At 6, you enter a candle breakout. So when this candle gets higher than that, when you have an owl entry, you use a Z2 as your initial stop, or the belly of the dragon, or the belly of the RL10. I would start off using the Z minus 2 to give you a nice, comfortable, wide, manageable stop. You'll never take more than a 1-hour execution stop if you use Z2. So get used to that, then learn how to tighten it up as you go. Then further up, you have the possibility for pocket re-entries or pocket additions and to manage your stops. And then here's an example of an RLXD entry, or exit, excuse me. Now this red dot is an example of an owl to the short side. You just had a powerful, unambiguous move. You had a P1, even though it occurred way over here, that's still a P1. It started to roll over. And now this is not an owl entry at the first red dot because the dragon and the 30 haven't rolled over yet. Even though you got the RLXD, the dragon and the 30 have not rolled over. But here, you still have that unambiguous move. You have another RLXD. That second one is quite often the powerful move, especially when the RL10 excursion was lower than the previous one. And now you have the RLXD, and you have the dragon and the 30 all rolled over. Notice in this case, this is one of those unusual cases where the RL30 turned before the dragon did. I don't mind if you take that as an owl and call it an owl. I would rather see you take this one or an entry anywhere in here, but then you get the owl follow through. So in a nutshell, that shows you 2 owls, one in each direction, and important insights into the RLXD and the role that it plays in the third criteria in an entry. It can be the third, that criteria this way is good enough to get out, but not good enough to get short. So that's the owl flashcard. This is a psychological state that says, look, in order to get into the 0 state in the battle circle, you're going in there to fight for your life, in my view, and you're going to trade naked. That's you, naked, 2 hands on your sword, and you are ready, you bow to your opponent, and then you fight. That's my mental model for what I'm doing when I'm trading. It's not the only model you can have, but it's the one that I use, and it resonates with who I am and how I behave over the last 40 years. So when I'm trading, I am in the zero state. It's me alone, naked, two hands on my sword, ready, bow, fight. So I have a mental mindset that says when I enter that circle, I'm ready to go. Remember, plan, prepare on this side. Then I'm ready when I walk through that corridor and into the circle and get on the mat. So in the ready room, what I have to do is I have to offload everything, stack it neatly because I'm coming back. And I'm going to respect the room by stacking my stuff neatly because other people use that room. And then I'm going to get my equipment ready. And then I'm going to prepare my heart and mind. And then I'm ready. And then I go. And now I'm in the circle. So in the ready room, that's what I'm doing. It is a sacred place. And I go in there for one reason, and that is to get ready to go fight for my life. Now, to offload everything, what's the everything? Well, it's everything else. In the world, is filled with things like goals and habits and skills and games and thoughts and feelings and issues and practice and prep and dreaming and emotions and memories and news and bullshit. And when I walk in the trading into the ready room, that's what I do. I've offloaded everything. It is stacked neatly because I'm coming back. I get my equipment set. I prepare my heart and mind. I get ready, and then I go. And then when I'm in the circle, it's no mind. It's me, naked, two hands on the sword, fight. That's the zero state that I must be in. If I'm not in the zero state and can't get there immediately, I got to get back out of there and go back to the ready room, get my mind right, and then go back to the battle circle. And when I'm done for the day or the week or the month or whatever, then I can go back to the world. But the ready room is a very important emotional, spiritual, mental, psychological place for me to get ready. This is the chart that accompanies the pinch and stretch idea and the Z3P concept, which is something from nothing. There was some move on any time frame that was so strong, we might call it leg one, and it ends up getting sideways though, and it's in the Z3 lines, or the price is staying within a frog box, and then it goes sideways long enough, and the volatility is low enough that now the Z3 lines are inside a frog box. That's a Z3 pinch. Everything has calmed down, and this is what I call the pause. It's not going to stay here, or it's going to stay there forever, and then it doesn't matter. The bigger the move that preceded this, the more likely it's going to move out of the pause. The insight is this is just another form of the 2R battle drill. And so maybe I had a trade and it enters the frog box in the Z3 pinch very near where the 2R point was. And so it's closely related to that idea of preserving the profit, but on its own, it's also an idea of how do I know on price action, how do I zoom in and know when to break out and take it as a continuation pattern or the next leg up. Maybe I exited, and then maybe I want, because it didn't fail, maybe I want to re-enter at the low end of this channel and then just play for the far side. And if it starts to fail, make bank. Or if it breaks out, I got a great entry compared to the breakout, which is where I want to go. So this Z3 pinch box, if it gets down to like 0.7 of a frog box, it's game on. And now I'm prepared to go in either direction. That's the conceptual frame of reference that this chart shows with actual bars and markups and codes. But the conceptual diagram that led to that was rendered in the following way. This chart talks about the river. And in the middle of that river, from Z1 to Z minus 1, if this was on its side, imagine you took that river that was flowing from left to right and had it flowing from bottom to top. It would look like a normalized histogram, but with fat tails. In the middle, between Z minus 1 and Z plus 1, or Z plus 1 and Z minus 1, live dragons and crocodiles. The crocodiles to eat you up. The dragon acts as a guide for keeping the trend running and then knowing when it's time to cross to the other side and beat the crocodiles to the other side. In the middle, you have normal trop. There's no trend, but it's not necessarily quiet. So you could consider this the noise inside Crocodile River. And you could think of Z3 as the excursion, the maximum excursion possible until this thing becomes discontinuous, like the flood of the century. And it overruns not only the floodplain, but far beyond what's been seen in the last 1,000 bars. That's what those Z3 red lines look like. That's the normal chop. So don't try too hard to make trades inside the Z river from between Z minus 1 and 2. That's where the crocodiles are going to eat you up. See them in there lurking in the muddy water? They're there all the time ready to chew you up. And so sometimes you have extreme volatility on the left-hand side where you've already seen an unambiguous move. And now, like maybe there was a Z3 breakout and it had this enormous directional move and it left the river behind. That's like what was the precondition to an owl. The river is going to slowly follow, and then all of the price and the 10 and the 30 leave the river, and then the river will look to be very clear because it's not cluttered up with all that price action. And then eventually, the dragon is going to swim over to the side of that river and then parallel you as price moves down. And then at some point, you're going to get a P1, and then it's going to go through the RL30 and then across the dragon and into the river to the far side of the river and maybe fight its way all the way across. That's what happens when you have these unambiguous moves and trending behavior. But maybe only 30% of the time does it unfold like that. 70% of the time, it's going to muck around inside this crocodile river. And then at the other end of the scale, when you have unusual behavior, it's so sideways quiet channel that, like the Z3 pinch, you get the Z3 lines have now pinched inside along with price inside a frog box, and now you get the Z3P and maybe even a super pinch, and then it breaks out in either direction, and you get this enormous move that we could roll all the way back over, and now suddenly you're looking at this. So these are the three categories or life cycle buckets of what's going on in volatility. And when you roll it vertically like this, you can see very clearly three different things going on by category. Then roll it back 90 degrees to the right, and you see it going from left to right. And then it maybe is a little bit harder to see because you're thinking about price. But conceptually, if you can just rotate that 90 degrees to the left and go from bottom to top or south to north, or the same way that you drive a car, you could see it as a two-lane road with that yellow line in the middle is the Bollinger Band mean. And when it goes off the road, something special has happened. And now you're going to have an opportunity to make a larger than normal corrective move in a short period of time. If it goes off the road to the left, then you have a runaway trend that you want to try to catch or preserve the move as it tries to fight its way back onto the road. Or in the case of a super quiet, this is like a narrow road, and suddenly you're going to have a lot of traffic and it's going to break out sharply to the other direction when a new road appears. So this is a psychological exercise in understanding what the metaphor of the river, the dragon, the crocodiles, and the pinches and the fat tails mean. Finally, this is the essence of that of the diagram of the dragon. And this is the case of an intraday move where, let's say, price has sold off with the RL10 to a maximum or to a new minimum. And now the dragon has rolled over and come down there in the RL30. And now you get the stages of the RL10 has reversed, makes a P1 alert, enters the dragon, crosses the dragon. That's the RLXD. And now it's in the pocket until it breaks out the previous hump of the dragon or the RL10, I would admit. So the distance between the belly of the dragon and the hump of the dragon, this whole area is the pocket. And if you could just say, well, what's the best place to enter? Is it right at the RLXD or right after it it crosses and you have an emerging dragon when it takes out the hump. I just say, imagine there was some point right in the middle of those two that was the average entry. To me, the best pocket entries are somewhere in between the RLXD and halfway up the stack. You're buying in the bottom 1/3 of the pocket. To me, that's kind of the ideal spot. I want to try to get in there as quickly as I can. And then if it gets to the hump of the dragon and starts to fail, then I can already pay for that trade. Now, a special case is when this is intraday. You might just during the day find that peak bottom of the dragon or the RL10, and then just put a frog box on it and say, if it moves through this pocket and I haven't made my entry yet, and if I haven't taken the emerging dragon, by the time it moves a full frog box off that swing low intraday, maybe it's the low of the day because it was right from the open, or maybe it was something that happened after lunch. Whatever that observable temporary swing low looked like, and you put a frog box on it, and you're starting to try to figure out where you want to enter, you could do the RLXD, the pocket entry, the average entry, the emerging dragon, or not later than a frog box off that swing low. If you're waiting longer than a frog box for that move to unfold, that may just be not the time frame for you to be trading, because there's plenty of signals that we can manage. We don't have any certainty about the follow through. In fact, the closer to the turning point, the closer to the RLXD, the more likely it is to fail because it hasn't really put in the big move yet. But that's the kind of uncertainty you have to manage in order to be open to the possibility of capturing those insights and those gains. Now, this is a special case where, let's suppose that you had an open here and you put a hybrid frog box in either way, and this thing moved a hybrid frog box off the open, so you got in, and then the gain stat was right up here, and you knew where that was because you paid attention in class and you mapped that out, and maybe you got the hybrid frog entry and this thing got to a gain stat and then started to fail. Don't be so committed to this hybrid frog that you watch a gain stat happen and it starts to fail, and don't let it come all the way back and take a full hybrid frog loss. The failure at the gain stat is new information that was not available when you made the entry. So just go ahead and scratch it and say, not today. I don't like taking losses. And if you have enough information to suggest this thing isn't working like it should, don't try to revert to, well, I'm just going to follow the rule. Just use the information that's available. Don't settle for a full R loss or a hybrid frog full loss. Use the gain stat for the information. That's a special case for intraday trading that I want to share with you. And especially if you're getting into these things in the first 5 or 10 minutes, that can save you from getting poorly started and allows you to stop and reverse the other way with a clear conscience. Okay? So those are the 17 standard day trading flashcards that in all future day trading workshops, I'm going to make sure that before guys fly out here to Kansas to trade with me in the time after the virus, that they better understand all 17 of those locked in. Know those cold, or you're not ready to fly to Kansas yet, I don't think. Because I just told you what I'm going to tell you if you brought a question about it to the workshop. So don't fly out here and have me explain it again unless that's just what's needed. And then by all means. But that's what we've learned through hammering out these ideas like a samurai sword. You know, you start with that iron, you heat it, you pull it out of the fire, and you hammer it on an anvil and fold it, and then reheat it and just keep doing that. Iron sharpens iron. That's how you make the stuff work. So those are the 17 lessons. There's probably 30 lessons in there. There's probably a lot of overlap between that and the 37 strategies document. But sometimes there's a different feeling when you hear it and you see it on one page like that. So that's what I wanted to say about those 17 flashcards, which will be part of the boot camp workshop. and which is now part of your repertoire. And then I'll get this thing processed and hung on Patreon for those of you who are, gold members and above. So at this point, I'm ready to take any questions you have. I either lost connectivity with you, or I've been unusually clear, or my reports Friday night were good enough. But that's everything that I wanted to say about these flashcards. And we're an hour and 5 minutes into the briefing, so that feels like a natural place to stop. So I'm going to stop the recording there so I can start processing it immediately, but I'll stick around